Hello everyone and welcome back to the lesson. Today we are going to study another source of long-term funds known as Islamic finance. In studying Islamic finance, we are going to discuss the characteristics, the benefits, and the drawbacks of Islamic finance. Islamic finance is a long-term source of funding for businesses. And Islamic finance refers to the means by which corporations and individuals raise capital in accordance with Sharia, in accordance with Islamic law. And this source adheres to principles that prohibit the payment or receipt of interest, and it emphasizes risk sharing, it emphasizes ethical investments, and the avoidance of activities considered non-compliant with Islamic principles. At a later stage in our video lectures, we will be studying Islamic finance in detail as a topic. Here we are considering it as a long-term source of finance, and we will be looking at three things. One is characteristics of Islamic finance. Characteristics or features or attributes of Islamic finance. Now, one feature, the overriding feature of Islamic finance is the aspect of interest-free. Islamic finance is an interest-free financing option. Interest-free financing. What does that mean? That means that one of the fundamental principles of Islamic finance is the prohibition of interest, what is referred to as Riba. Instead, Islamic finance relies on profit-sharing arrangements and asset-backed transactions. It does not encourage earning of interest, that is selling of money to earn interest, as it is the case with the traditional banking or conventional banking, where banks sell money to receive interest. In Islamic finance, there is the profit-sharing arrangements and asset-backed transactions. Asset-backed transactions are asset-backed financing. Let me put it that way. Asset-backed financing is yet another characteristic of Islamic finance. Islamic finance encourages asset-backed dealings. It encourages asset-backed financing where transactions involve tangible assets or services, ensuring that financial dealings are backed by real economic activity. It discourages lending money to earn interest. There has to be real activity, economic activity behind all the transactions. There is also the aspect of risk sharing. Risk sharing, including even profit sharing between the financial institutions and the investors. And to make it specific, it's not just profit, but also, let me put it, loss. There is sharing of profit And when there are losses made, there is also sharing of losses. Risk sharing, profit sharing, loss sharing. Islamic financing emphasizes risk sharing and profit or loss sharing mechanisms. We later on will be looking at contracts like the Mudaraba, the Musharakah contracts, for example, where profits and losses are shared between the parties. 4, avoidance of speculative transactions. There is avoidance of speculative transactions. Now, Islamic finance discourages speculative transactions and investments in activities considered forbidden. What is termed as haram. In Islamic finance, in other words, Islamic finance cannot be used to fund forbidden activities like gambling, alcohol, investment in other types of speculative trading. There are limits to which Islamic finance can be applied. 5, ethical investment. Ethical investment. Islamic finance encourages ethical and socially responsible investments that align with the Sharia principles. So investments in businesses that are engaged in activities such as gambling, such as pork, such as alcohol, are avoided. You cannot use Islamic finance to invest in activities that Sharia considers unethical. So these are 5 characteristics. Let's move on to highlight the pros of Islamic finance. The benefits of Islamic finance. One benefit is ethical and moral values. One related to ethical and moral values. Ethical and moral values. Islamic finance aligns with the ethical and moral values, providing a financial system that adheres to principles of fairness, transparency, and also social responsibility. That is an advantage of this type of this source of long-term finance, ethical and moral values. There is also financial inclusion. How is financial inclusion a benefit in Islamic finance? Now, Islamic finance promotes financial inclusion by providing financial services to a broader population, including those who may avoid conventional finance due to religious reasons. Financial inclusion. Risk sharing is yet another advantage. Risk sharing. Sharing of risk. Now, the emphasis on risk sharing in Islamic finance can lead to a more equitable distribution of risks and rewards between parties involved in financial transactions. 4, stability during economic downturns. Stability during economic downturns. Now, the avoidance of excessive leverage and speculative activities in Islamic finance can contribute to greater stability during economic downturns. 5, innovative financial products. How is this a benefit? Now, Islamic finance has led to the development of innovative financial products that adhere to Sharia principles, such as the Islamic bonds, which are known as Sukuk. These are Islamic bonds. We also have what we call Islamic mutual funds. These are innovative financial products. There are more which we have an opportunity to learn when we'll be discussing Islamic finance as a topic under the financial management syllabus. Let's move on to outline the cons of Islamic finance. What are the downturns of Islamic finance? What are the drawbacks of Islamic finance? Just like the other sources of finance which you have studied and those which we intend to study, each source of finance has drawbacks or disadvantages. One of such in relation to Islamic finance is that Islamic finance has limited product offerings. Limited product offerings. The range of available financial products in Islamic finance may be more limited compared to the conventional finance, and this limitation can impact the diversity of investment options. It is also complex. This source is complex. Let me say complex structure. Complex structure. Some Islamic financial products can be structurally complex, requiring specialized knowledge and expertise both for both financial institutions and investors. Complex structuring. 3, lack of standardization. Lack of standardization. Now, there may be lack of standardization in Islamic financial contracts and structures, leading to various ways in interpretation and application across different jurisdictions and institutions. So there is lack of standardization as far as Islamic financial contracts and structures, which may lead to various or variable ways in interpretations and also application across different jurisdictions. There could also be challenges in global transactions. Challenges in global transactions. Challenges in global transactions. Islamic finance faces challenges in global transactions due to varying legal and regulatory frameworks. And currently we have harmonization of standards, which is ongoing. There is an ongoing process to harmonize transactions from a global perspective. 5, higher costs. Higher costs. Higher costs. Now, in some cases, Islamic financial transactions may involve higher costs compared to conventional finance due to the complexity of structures and the need for compliance with Sharia laws. So these are 5 disadvantages. We've highlighted 5 benefits and 5 characteristics. The first characteristic is in relation to interest. Then this is asset-backed financing. Third is risk, profit, and loss sharing. We also have avoidance of speculative transactions and ethical investment. For the benefits, number 1, ethical and moral values. Promotes ethical and moral values. There is financial inclusion. We have risk sharing, stability during economic downturns, then innovative financial products like Sukuk and the rest. The first disadvantage is limited product offering, complex structure number 2, lack of standardization number 3, challenges in global transactions 4, then lastly, higher costs. So we've come to the end of the lesson, Islamic finance, which we have said in this lesson that offers alternative approach to the long-term financing that is based on ethical and Sharia-compliant principles. And while it aligns with certain moral values and provides innovative financial products, there are challenges, as we have seen in our today's lesson, such as limited products offering, such as higher costs, complexity in structuring, and so on. And therefore, there is need to carefully navigate the ways in which, to consider all these factors before deciding whether to use Islamic finance as a source of long-term funding. We're saying while it aligns with certain moral values, this source aligns with certain moral values. Okay? This source also provides innovative products, financial products. There are challenges such as limited standardization. There is also potential complexity in structures that need to be carefully navigated. So Islamic finance candidates has, in the recent past, experienced significant growth, and it continues to evolve, contributing to the diversification of global financial landscape. So thank you for attending the lesson. Here is your today's assignment. Question number 1. What are the key principles of and features of Islamic finance, and how does they differ from conventional financing methods? Number 2, how does Islamic finance accommodate the prohibition of interest, and what alternative mechanisms are employed to facilitate financial transactions within Islamic financial system? Discuss, number 3, the types of Islamic financial instruments such as Mudaraba, Sukuk, and how they are used for various financing purposes in Islamic finance. Thank you for attending the lesson. In our next session, we're going to study initial coin offerings, the ICOs. Bye-bye.